Hello there, finance staff. I'm sitting here and I want to go through an example of how we can try to convert cash customers into a prepaid lease. I know some of the departments have been having some luck with this, but we're doing some lease training in the showrooms, and some of the materials we could also use in the finance offices to try to convert that customer from a cash transaction into a prepaid lease. So this is the form that we're going to use, and I'm going to make sure you all get copies of this over the next few weeks. This is a form we call How It Works. It just explains how leasing works conceptually and some of the benefits. And then this is a comparison example comparing a straight cash purchase with what a prepaid lease would look like. And again, it goes over some of the benefits of the lease at the bottom. So I'm going to role play this as if I was a finance manager reviewing it with a customer. We always want to review the How It Works page first, because in a lot of cases these customers may have never considered leasing a car if they've always paid cash, or may not understand how leasing works. So since this OnePay is a lease program, we want to make sure the customer understands that it's a lease program and how leasing works up front. So I'm going to role play this now. So, Mr. Customer, I know you planned on paying cash for the vehicle today, and that's certainly an option that you have. We'll always take cash or a check for the vehicle. But one of the things I'd like to show you is a way that you can pay for part of the vehicle today and take an option on the second half, which may have some cash flow benefits for you, particularly if you do decide to trade your car in every 2, 3, or 4 years. So if you don't mind, I just want to walk through that with you right now. Basically what it is, it's a prepaid lease where you'll have the vehicle for either 2 or 3 years, pay one payment up front instead of paying for the whole vehicle, and keep a lot of your cash freed up and in the bank for other things, or to use if you'd like to execute the purchase at the end of the lease. So basically what we have here is a sheet that shows how leasing works. Whether you decide to pay cash, lease, or traditionally finance a vehicle, it starts the same way. We have to go out and select a vehicle and establish a selling price. Obviously that's already been done for you because you're sitting here in my office getting ready to go over the paperwork. In this example, which is just for conceptual purposes only, just to show you how leasing works, in this example we used a $40,000 selling price because that's about the average price of all the vehicles that we sell across the board here through the Ciocca dealerships. So with a lease, instead of paying the full $40,000 in tax and tags, what we do is we establish that selling price, then the leasing company establishes what we call a residual or a guaranteed future value. We subtract that from the selling price. You only pay the difference, which is depreciation. Now, in a traditional lease, that would be broken up over either 2 or 3 years. But in a prepaid lease, basically you pay all of that up front and have no payments for 2 or 3 years and enjoy the vehicle during that time. So at the end of the 2 or 3 years, some customers think, geez, Jeff, that's great, but I just threw all that money away and I don't have anything. And that's really not the case. What happens at the end of the term of the lease, whether that's a 2 or 3 year term, you have the option, you have a number of options based on the residual value of the vehicle. In here, just to make the numbers easy, we used a $20,000 residual and a $20,000 depreciation just because it's 50-50. Again, it makes the math simple. But the first option that you would have is if the vehicle didn't depreciate as much as the leasing company or the manufacturer thought it was going to depreciate, let's say it was worth $22,000 at the end of the lease, you would be able to trade that vehicle in or maybe sell it back to the dealership and retain any profit, either in a check back to you or in trade equity towards your next vehicle. Now, sometimes what happens is the vehicle depreciates more than the manufacturer thought. In that case, if the vehicle was worth less than $20,000, you could exercise your right to just turn that vehicle in and avoid that loss. Whereas if you were in a finance situation and you owed $20,000 on the vehicle and it was worth less, you'd have to roll that money over. Or even if you owned the vehicle and you want to trade it in and you only got $18,000 for it, you would have really spent $20,000 or $22,000 in depreciation, not $20,000. Now the last option is if you really love the vehicle and you think it's the greatest vehicle you've ever owned and you'd like to continue the ownership experience, you have the option with a preset amount in the contract based on the residual value that you can purchase the vehicle at lease end. And like I said, that can never be taken away from you. It will be in the lease contract. Now, I've never prepaid any leases, but I do lease all my vehicles for my family, and my father's actually in a prepaid lease on a Subaru Outback right now. But some of the things that we like about leasing is I don't have to sign a long-term contract to have an affordable monthly payment. Again, for you, the cash buyer, that's not as much of a concern. But one of the things I really like is I get out of my car before it starts to incur higher maintenance and repair costs after the warranty ends. And once we need to start replacing things like brakes and batteries, even regular maintenance, once it gets beyond 40 or 50,000 miles, we start to do more maintenance to the vehicle when it comes in for its regularly scheduled service visits, which cost more money than just oil changes and tire rotations. The other thing I like is I don't have to worry about negotiating the trade-in value because the leasing company is going to establish the minimum value of the trade-in with the residual value. And if the vehicle, again, is worth less than that, I get to walk away from it and not suffer any loss. If the vehicle is worth more, I get that upside profit or the opportunity for that upside profit or equity. I don't have to assume, any resale risk because of the residual value. Again, the leasing company's assuming that for me. And I like to be under warranty the entire time I drive my vehicle. So whether you drive the vehicle for 2 or 3 years, most customers during that time stay within the manufacturer's scheduled maintenance or the manufacturer's warranty. And if you go beyond that a little bit, we do have extended coverages that can cover you for the mileage that you're going to put on the car over the course of that 3 years if you're a little bit of a higher mileage driver. So as you can see, the lease plan gives you the benefits of conventional financing or paying in cash, which is that ownership and equity, but it also gives you the benefits of leasing, which is having a short-term contract, having someone else assume that resale risk and being able to avoid any type of a loss on the vehicle. Some of the other things I like is on a lease I pay less in sales tax. I have a lower overall cash outlay during the time I'm driving that vehicle. Again, I really like avoiding that resale risk and giving that to the leasing institution, having that shorter term and guaranteed future value. So on this side of the page, we took a $60,000 vehicle, and typically our cash customers tend to buy more expensive vehicles or a little more affluent. So we took a $60,000 cash vehicle, and we decided to lay that down on one side and then show you how a prepaid lease would work. And again, this is an example that we pulled earlier in the year. It has nothing to do with the transaction that you're looking at. So again, the vehicle selling price here is $60,000. In the state of Pennsylvania, we have to pay sales tax at 6%, which is $3,600 that gets added to that vehicle's balance. So the total balance is $63,600 plus whatever fees you would have for transferring or getting a new license plate. So your cash outlay here is $63,300. So at the end of 3 years, again, you have that vehicle fully paid. Now, you have assumed all of the resale risk if you want to sell or trade that vehicle. There's a number of things that go into making up the value of that car when you go to sell it in, things like the mileage, the condition, the market conditions or the economy at the time you decide to trade the vehicle in or sell it, the equipment level on the vehicle, if there's been new technology that's been developed that maybe devalues the vehicle that you have now because it doesn't have that new technology. Like I said, a number of these things go into making up the value of the vehicle. If there's been an accident with the vehicle, regardless of whether it was your fault or not, they all go into making up the value that you'll get for that vehicle when you decide to sell it or trade it. The other thing is that if you keep the vehicle beyond 3 years past the manufacturer's warranty for most of our vehicles, and even if the manufacturer's warranty is a little bit longer than that, once you get into years 4 through 6, a lot of things need to start to be addressed on the vehicle from a wear and maintenance standpoint. Things like tires and brakes, batteries. When we do maintenance visits, we're doing more sophisticated maintenance, like replacing belts and hoses. We're flushing out systems in the vehicle like the brake system, maybe the transmission system, the cooling system. If we don't address those things as the vehicle gets older and they fail, they could cause a very expensive repair that you would then have to pay for out of your pocket. So we like to recommend to customers to be proactive and spend the little bit of extra money up front to prevent those larger expenditures from possibly happening. Now, you're probably familiar with Edmunds.com. It's a great a great resource for customers to go do research on new and used cars. If you go into Edmunds, they have a spot on their website called True Cost to Own. And we looked into true cost to own on Edmunds. And in that spot on the website, it'll give us 5-year ownership estimates for things like fuel costs, insurance costs, depreciation, financing costs if you decide to finance your vehicle. But they also look at maintenance and repair as separate line items. So we went in and plugged in a variety of different vehicles, from our Mercedes, Audi, and BMW manufacturers all the way through our Ford and Chevy stores and our import stores like Nissan, Hyundai, Honda, and Toyota. And when we did that, according to Edmunds, the average customer through our dealerships will pay between $4,000 and $6,000 in maintenance and repair in years 4 and 5 on things like those things I just mentioned to you. So it's not a monthly cost, but if it were, it would be about $160 and $200 to $250 per month. And now you really are in that position where you do have a used car and you're on the hook for all of those potential expenses. A lot of the manufacturers said, hey, there has to be a better way. We know our customers like to avoid those costs. They like to stay under warranty. They like to have the latest safety and technology in their vehicles as well. So they came up with short-term leasing. And in particular for cash customers, they came up with a program called the one-pay or prepaid lease. So in this case, in this example, the same vehicle at $60,000, because we don't pay tax on the lease price, we only pay tax on a lease when we spend money, there's no initial tax assessed. It's actually on the payment. So we have a balance of $60,000. The monthly payment on this vehicle for 36 months came out to $740. Now, the state does assess a 9% sales tax on the payment only. So in this example, that's $67 per month. It gives us a payment of $807 per month. Now, if the customer chose to make all these payments up front, they would be able to drive the car for 3 years for an upfront cost of $29,052, including all the state tax that would be collected. Now, at the end of 3 years, they would have a fully paid contract. Actually, you have a fully paid contract at day one, but at the end of 3 years, when the lease is up, you have a fully paid contract. You don't owe anything else on the vehicle, and you own options, 3 options on that future option price of $35,200. Again, if the vehicle's worth more than that, you get to trade it in and retain any equity, or sell it and retain any equity. If the vehicle's worth less than that, you could turn that vehicle in and walk away and not suffer any additional depreciation. And if you said, hey, this is the nicest vehicle I've ever owned, I'd really like to continue the ownership experience, you have the guaranteed option to purchase that vehicle for the predetermined price in the contract. So that's never taken away from you if you do like to own the vehicle at the end. So again, it gives you the best of both worlds. You have that opportunity for profit and equity and ownership, but you also get the benefit of driving the car for the best part of its life and avoiding all of the resale risk. Which do you think makes more sense to you?